So are you ever scrolling around on social media and you see those like motivational posts about entrepreneurs like, oh, you can fire your own boss now, or make today yours, or follow your dreams. And, their intended purpose is just to get you fired up. But what happens when they work? Okay, great, I'm fired up. I'm ready to branch out on my own. But now what? Where do I go from here? If you're thinking about becoming an actual entrepreneur, then you're more than likely going to be looking for funding options to help you get your business off the ground. Because let's face it, launching an actual business is expensive, it's time consuming, and because of that, securing capital is absolutely essential. But with all the different types of funding available, how do you know which one is the right choice for your business? Well, that's the question that we're going to be answering in this very video. Now, before we get into it, I just wanted to thank you for tuning in and mention that if you are really interested in growing your business, then your best resource is to subscribe to our channel so you can continue learning and staying up to date on the latest tips and tricks that's going to help you grow and succeed. So with that being said, let's look at some of the most common startup funding options, the pros and cons of each, and how to pick the best option that's going to work for you. So what exactly is startup funding in this case? Well, what we're talking about is the money that an entrepreneur uses to launch a new business. So worst case scenario, this could be your personal savings, or using your existing salary, or borrowing from friends and family. Those are prime examples of what you don't ever want to have to do. Now, what should you do instead? Well, you've got standard business loans. So typically, these are provided by a financial institution, a bank, or a credit union. A lender gives you a lump sum of money, and you must pay it back over a fixed period of time. Repayment terms can be up to 10 years, and loan amounts vary from $5,000 all the way up to about $1 million. So in addition, interest rates on these loans are also going to vary. So as of this video, they can go anywhere from 6% all the way up to 36% interest. Interest and fees are included and vary depending on your credit score and lender. Now, these loans that we're talking about here are not backed by the government, so there is more risk for the lender if the borrower defaults on the loan. So because of this, these loans require higher credit scores. They require strong financials and an established track record as a business owner. And on top of all that, just to qualify for the loan, you may have to disclose what your intentions are for using the funds. There's also SBA Micro-Loans. So startups can get capital from private and nonprofit lenders through the Small Business Association. This kind of loan is usually secured by either collateral or the assets the business plans to purchase with the said financing. The SBA actually partially backs these types of loans, which guarantees to the lender that they're going to pay back a percentage of the loan if you happen to default on it. This lessens the risk for the lender, resulting in better terms and interest rates than your standard run-of-the-mill business loans. Now, SBA Microloans typically prioritizes minority or underserved small businesses like women or veteran-owned. They also tend to have pretty favorable terms. Interest rates vary from 6% to 9% as of February of 2023, and term length is usually at or under 10 years. Microloans can lend up to $50,000, but according to the SBA, the average microloan is only about $13,000. The other thing to keep in mind about microloans is that they cannot be used to pay existing debt or purchase real estate. Another option for startups is venture capital. So venture capital is a form of private capital that investors provide to startup businesses that they believe have long-term growth potential. This type of startup capital usually comes from investors, investment banks, or other financial institutions. Basically, just think like Shark Tank. Now, unlike a traditional loan, companies don't need to show cash flow or assets to secure funding. Venture capitalists may also offer mentoring or networking opportunities to help the company grow and secure that top-notch talent. Now, there is a significant amount of risk for the investor, since if the business doesn't succeed, they won't see a return on any of their money. As a result of this, venture capitalists typically want at least a seat on the board of directors of the businesses that they finance, and some want even more ownership of your company, anywhere from 25 to 50%. So from this, you may lose freedoms and creative control, as any ideas will have to be approved by the investor who now holds all the cards. So next option, business credit cards. Business credit cards are a great tool for startups because they give you access to large amounts of funding at 0% interest for anywhere from 6 to 24 months, depending on the card. You can typically get unlimited access to business credit if you continue showing the banks that you have a need for the funding and show aggressive repayment. Those are the two major things that the banks are looking for. Now, we at Fund&Grow work with startups that only need $20,000 to get started, but we've also had some startups who needed all the way up to to like $250,000. We help them get access to those high amounts with the best zero interest terms. Now, yes, I did say $250,000, and those bigger amounts sometimes scare startups. But unlike traditional loans, you only pay back whatever amount you use compared to how much you're approved for in a loan. Also, another great factor, you don't have to tell them what you plan to buy with the credit. It's super flexible. And your industry doesn't matter as well. You can get cash back and rewards, which isn't offered by any other option out there. And there's no collateral or giving up equity in your company. Now, many startups won't even think to go after business credit because it's often linked to being established for a few years or needing to show financials, but that's just a common misconception. Some people don't even know these offers exist from the same banks that they already use. So as I said before, we've helped plenty of startups access this type of funding, and so if you need something like this, whether it be $20,000 or $250,000, I've actually linked our masterclass for you in the description, so you guys can go check that out after you're done with this. And our final funding option for startups is crowdfunding. So crowdfunding is when an entrepreneur raises money, usually through an online campaign, for their business. There are four major types of crowdfunding. You've got donation, when people give a company money for nothing in return. GoFundMe is an example of a donation-based crowdfunding platform where people can donate towards your cause or business's success without getting anything in return. Another variation of crowdfunding is just debt. In this case, the money given by peers must be repaid with interest by a certain date or deadline. You've also got reward-based crowdfunding, so when a donor receives something in return for donating to the cause. The reward size is usually dependent on the amount contributed by each individual. And the other crowdfunding option is equity. Now, while most crowdfunding opportunities don't allow backers to own a portion of the company they're contributing to, there are some platforms that allow small businesses to give a portion of their businesses to the contributors. Typically, participants will receive a certain number of shares in the company based on how much they contribute monetarily. Most crowdfunding platforms have specific rules you must adhere to, such as not offering equity crowdfunding or a list of prohibited items that you can't have in your project. Kickstarter, which is another crowdfunding platform, for example, prohibits crowdfunding any item that claims to diagnose or cure an illness or political fundraising, along with other rules that must be followed by anyone using that platform. So let's sum up here with a short little checklist of all the things we've discussed so far. So how do you know which type of startup funding is right for your business? Well, one of the biggest factors is to think about how much funding do you actually need. That ultimately, at its core, is going to push you in the right direction. Then consider, what are you going to use the funding for? You don't want to pursue an option that restricts use on the purpose that you need the funding for. How much control of your business are you willing to give up? If you don't want to give up equity or creative control of your business, well, that's also going to help steer you clear of any methods that make you do so in exchange for funding. How much interest are you willing to pay? Answering these questions will help you immediately cross out some of the options that we talked about today and point you in that right direction. So I know this was a lot of information to take in, but there are a lot of options out there, and we believe that entrepreneurs should always be informed of what's available to them. Hope you guys have a better understanding of the different funding options at your disposal, and more importantly, how to pick the best one for your business. Remember, it's important to take into consideration both the pros and cons when choosing a funding option for your startup. And because there is no one-size-fits-all approach, each business is different and has its own specific needs. So thank you so much for tuning in today. If you have any questions or comments about anything we discussed, feel free to leave them below. Of course, I'll see you in the next video.